Right, so a machine costs 180,000. It has no salvage value and has a useful life of 5 years. Depreciation is done using the straight line method, right? The cost of capital is 10%. The tax rate is at 40%. Expected cash flows are as follows. Okay, as we can see here, this table here. So they've told us to evaluate the investment using the average rate of return. Right, so what we're going to do is save a solution. Right, let us calculate. Remember, we are focusing on profit, so let's calculate our depreciation, okay, and also the tax, so that we can get our profit. Okay, so we say depreciation, we say depreciation equals cost minus scrap value divided by the number of years. Okay. So here our cost is 180,000, and we do not have any scrap value. Okay, meaning after the end of 5 years, this machine will be worth nothing. Right, it will be worth nothing. Can't resell it for any amount. So 800,000 minus 0 divided by the number of years, 5 years. The total the useful life is 5 years. So we're going to say 180,000 divided by 5. So depreciation is 36,000. 36,000 kwacha. Right. So every year, machine is going to be it's going to be losing its value of 36,000 every year. Okay. Now, after we've calculated the depreciation, we have to now calculate the tax. So if you remember, the formula to calculate the tax is tax equals the cash flow minus depreciation by tax rate, right? Because after we find the value, we find the tax. Remember that profit equals cash flow minus depreciation minus tax. So we want to find the value of tax here, the total value of tax. Okay. So what we're going to do is we're going to make our table here. Okay, make another table here. So say year cash flow, depreciation, tax, then profit. So say year cash flow, depreciation, tax, and then we get our profit because we're striving to find our average profits here. Okay, so we say year one, okay, we have 36,000, not 36,000, 76,000, right? Depreciation is 36,000, right? Depreciation is 36,000. So we're going to say year one, we'll say year one, want to calculate the tax, year one tax. And so we're going to say 76,000 minus 36,000, okay, multiplied by the tax rate is 40. So 40% is like 0.4, right? So it's 76,000 minus 36,000. We're going to get 40,000. Then we multiply that by 0.4, all right? We're going to get 16,000. So the tax is going to be 16,000. Right, Go to year 2. All right, cash flow, we have 68,000. Right, depreciation 36,000. Right, calculate tax year 2. Okay, we're going to say equals 68,000 minus 36,000. All right, times 40%, which is 0.4. Right, so 68,000 minus 36,000, we get 32,000 multiplied by 0.4, we get 12,800 as tax. 12,800. Okay. Then we have year 3. Okay, we said we're expecting 50,000. Right, depreciation is 36,000. Right, let me say tax, so we'll say 50,000 minus 36,000, we get 14,000 times 0.4, we get 5,600. Right, year 4, okay, we expect 84,000, and depreciation 36,000. Right, so we're going to say year 4, we're going to say 84,000 minus 36,000 divided by 0.4. So say 84,000 minus 36,000, we get 48,000 times 0.4, we get 19,200. Right, so we said 5 years. Okay, what year 5, we expect 100,000. Depreciation 36,000. So year 5, we're going to say 100,000 minus 36,000 multiplied by 0.4. All right, so 100,000 minus 36,000, that's 64,000 multiplied by 0.4, we get 25,600. 25,600. Right, now we can calculate our profit. Remember, profit is cash flow minus depreciation minus tax. All right, so we say 76,000 minus 36 minus 16,000. Okay, we say 76,000 minus 36,000 minus 16,000. We're going to get 24,000. Okay. That's the profit for year 1. Year 2, we say 68,000 minus 36,000 minus 12,800, get 19,200 as our profit. 19,200. And this. Right, then we go to year 3. Okay, I'm expecting 50,000. So say 50,000 minus 36. Right, 50,000 minus 36,000 minus 5,600. we get 8,400. Right? Then end of year 4, 84,000 minus 36,000 minus 19,200. Okay. 84,000 minus 36,000 minus 19,200. You get 28,800. 8,800. Okay, finally, year 5, 100,000 minus 36,000 minus 25,600. 100,000 minus 36,000 minus 5,600. You get 38,400. Right, so now we've got the profit of each individual year. So we're now looking for the average profit. Right, so to get average profit, first we find our total profit. Okay, so say total profit, TP. Okay, I'll just say T profit, total profit. All right, the total profit, we're going to say 24,000 plus 19,200 plus 8,400 plus 28,800 plus 38,400. We're going to get 118,800. All right, 118,800. Right, we have our total profit. Now let's get our average profit. Right, so say average profit. Just say a profit, average profit. Okay, that's just an average profit. Right, we're going to say it's equal to the total profit. Okay, our total profit divided by the number of years. All right, so this is going to be 118,800 divided by 5. Okay, divided by 5, and say 118,000, 118,800 divided by 5, we get 23,760. Okay, this is our average profit, right? Once we get our average profit, now we can now look forward to our average investment, right? Which is, when we say average investment equals the cost plus scrap value divided by 2. So since we do not have a scrap value, we say 180,000 because that was the cost of the machine plus 0, we divide it by 2. 180,000 divided by 2, and we get 90,000. Okay, so now we can get our average rate of return. We say ARR equals average profit over average investment times 100, and that will say average profit was 23,760 divided by average investment 90,000. Okay, multiply that by 100. All right, so we say 23,760 divided by 90,000, get 0.264. multiplied by 100, we get 26.4%. That makes lucrative. 26.4%, right? So now, what was our cost of capital? 10%, all right? And our ARR is 26.4%. Oh, we can just round it off to 26%. Is it 26%? Since ARR 26% is greater than the cost of capital, okay, cost of capital which is 10%, we accept. And we accept.